Um, Hello everyone, welcome to our latest Sifted Talks in partnership with Vanta. I'm Tom Matsuda, Sifted's fintech reporter, and I'm super excited to be moderating this very topical talk on how to build trust as you scale a fintech. So during this talk, you'll hear from our panelists how fintechs can not only build trust, but also maintain it, security practices fintechs can use while maintaining growth, how they can kind of balance innovation with kind of ensuring that the appropriate guardrails are put in place. And also, we'll also be chatting about the kind of role automation can play in all of this as well. But before I get into it, I want to introduce our amazing panelists. So today joining me, I have Conrad Ford. He's Chief Product Officer and Strategy Officer at Allica Bank, which is a fintech focused on the small and medium enterprises. Conrad was previously the founder and CEO of SM Credit Fintech Funding Options. I also have Marsel Fazilov, who leads Governance, Risk and Compliance Specialist at compliance and security platform Vanta. Marcel has previously held positions at Deloitte and KPMG. Also joining me, I have Sadra Hosseini, CEO of Ryft, which is an embedded payment solution platform for marketplaces and B2B digital platforms. Ryft just raised its Series A earlier this month and is planning to expand to the US, EU, and Middle East. And last but not least, I have Zeynep Yavuz, partner at VC firm General Catalyst, which is invested in fintech companies like Monzo, Zigo, and Rapid. Prior to General Catalyst, she was part of the product team at cross-border remittance company World Remit. Yes, so really looking forward to hearing from our panelists, but I guess just to do a little bit of housekeeping before I start. If you look at the bottom of your screens, there is a Q&A box with a little question mark in it. Yeah, this is a place just for our audience, really do feel free to send in as many questions as you can. And I guess what's slightly different compared to kind of other webinars or panels, we don't really have a dedicated section for Q&A. We'll kind of take these questions as and when they come. You guys can also upvote these questions, so we know which ones are kind of most popular, and we'll try to get them as we come to. And yeah, please don't be shy with the questions. We want this to be as interactive as possible, and I'm really looking forward to a lively conversation. So I guess to kick things off, customer trust is obviously very key across all sectors, right? But especially in fintech, when you're handling customer funds, whether it be kind of on the consumer side or the enterprise, it's particularly important. And I guess for that reason, kind of fostering customer trust has been the bedrock behind some of Europe's key fintech regulations, whether that be the kind of Payment Services Directive or PSD2 or the Digital Operational Resilience Act or DORA, which came to force earlier this year. But to start things off, I kind of wanted to go back to the beginning stages of kind of a fintech's life, and ask our panelists, like, what are kind of the key foundations or building blocks to build kind of customer trust in fintech, and how has that changed over the last few years? Marcel, would you like to take this one?
Yeah. I guess I'll approach it from a pretty biased perspective, having done a lot of IT audits and financial audits myself. But yeah, really just looking at the global landscape, seeing all the different cyber attacks and all the different cybersecurity incidents that are happening all over the world. Obviously, there's a lot more of a focus placed on cybersecurity and just maintaining trust in the market, because when you're working with different businesses across the world, you don't suddenly want to hear about, hey, we've had a breach, and suddenly all your data is accessible to whatever parties have access to it. To be honest, at this stage, there's probably a lot of threat actors going around. But yeah, really just the global landscape and the need for that sort of trust. Almost like a paranoid mentality is kind of developing just around, especially uncertainty. But yeah, just going down that cybersecurity route and just trying to develop baseline requirements for that is what I would say is the kind of driving the need for this at the moment.
And Sejal, what would you see as kind of the key foundations to building customer trust in fintech?
Yeah, afternoon, everyone. So for us, there's the basics. So we're handling money, we're handling millions of transaction points. So the basics are FCA license, EU license. So if we're in the flow of funds, we need to have those licenses. Then there is the stuff like PCI level 1, where we're handling people's data. So those are the basics that you got to have if you're a regulated business. And then on top of that, then there is the actually building that trust, because especially for us, we're in a competitive market. If we're doing that, other companies are doing that. But we have to build additional trust to be able to win these merchants and the bigger merchants that we're going after. So I think the best way that we've learned to do it is by looking at our suppliers and learning the bad ways that they've done it, and then learning from that and doing a better job. So transparency is super important for us. If something goes wrong, we have a lot of our suppliers that just go and hide until they've resolved it, and they come back and say it's all fine now. Whereas we go deep into, we're first to let the customers know there's something wrong. We're working on it. Here's transparency. Here's what we've done, and we're back to live. So making sure that you're kind of ahead of the problem rather than just running away, I think builds that trust, because they know that things will go wrong. It could be our platform, it could be the suppliers that we're working with, but being able to be there and kind of be at the forefront really helps win the client's trust over. Yeah, so I think those two big pieces are the best ways, especially as you're building trust early on, as you're scaling your own business. It's important to kind of have those as the bedrock, and then you can build on top of that.
And Conrad, I'm curious, kind of given Allica's focus on SME banking, what specific kind of trust building mechanisms work best when serving businesses versus consumers?
Well, firstly, I mean, we're a bank, so obviously trust is everything. A bank looks after ordinary people's money, and it's a very special regulatory status. I think my kind of starting point would be that there's an interesting dichotomy in financial services. You want customers to trust you, but you don't want them to be too trusting. Okay, so let me just unpick that. What are we constantly getting from our banks? We're constantly getting warnings about fraud. We will never do this. We will never send you an email asking for this. So you don't want your customers to be too trusting. And if we invest heavily, for example, in brand, right, it's very easy for someone to clone our websites and copy the brand. So the stuff that you invest in trust, you also want your customers not to be too trusting. So what can you manage? How can you manage that? At a macro level, there are certain trust signals that are very hard to replicate. So in our world of SME, LinkedIn is very important, particularly for sort of the key influencers of our business community, accountants, advisors, etc. Well, we've got 250,000+ followers on LinkedIn. That's very hard to fake, right? Trustpilot scores, again, anyone can stick a badge saying they've got 5 stars. But if you click through Trustpilot, you can see how many reviews there are. And again, that's hard to fake at a certain scale. Those things I think really matter. I think consistency really matters. One of the stupidest things you can do as a bank, and we're all vulnerable, we all do this occasionally, by the way, is tell customers we'll never do this, we'll never communicate in this way, and then that's exactly what you do. So consistency really matters. And actually, specifically in our worlds, our customers are ordinary businesses and ordinary business owners. And actually, we talk to them in their language, in their tone of voice. And actually, I think that builds trust. And above all else, because we do that consistently, I think if somebody tried to replicate Allica, fake Allica, it'd be quite hard to do because they have an expectation around what Allica is like to do business with. So I think these things really matter. You've kind of got to start from the most foundational points, things like brands, and then build downwards from there.
And Zeynep, I'm curious, kind of from an investor perspective, when you're kind of evaluating a fintech for potential investment, how do you kind of measure customer trust? Are things like the kind of LinkedIn following and the Trustpilot following that Conrad mentioned important, or yeah, are there other kind of metrics or measures that you look at?
So as General Catalyst, we invest. We're a multi-stage investor, but early stage is our core. So many times when we invest in companies, they might not have those metrics. So in principle, the way we evaluate trust is I'd say broken into two categories. One of them is more on communications. So how transparent are you in communicating your pricing, your value proposition, and not having any jargon in the way that you advertise your product. And the second evaluation is more around infrastructure. And on infrastructure, it's a question of how close are you to the metal? Are you running on a banking as a service provider, or do you have your own license? If you have your own license, how localized are you in the countries that you operate in? So that means, do you offer local IBANs? Are you integrated into the local e-signature providers? So this is, and for us, these are the core parameters of earning the trust of your customer, that you need to be very transparent in communication, and your infrastructure needs to be resilient. So this is how we typically evaluate our investments. When we look at slightly later stage companies, of course, we'll have more proof points on both the communication and the infrastructure. And at that point, we also start caring about features. And what I mean by features is, for example, if you look at Monzo, they have instant notifications on transactions. When you try to send money to someone, they will do a real-time account matching. They will also instantly freeze your card if you have any suspicious transaction. They have two-factor authentication that's very easy to do through the app. I wouldn't call these products, but these are features that are just showing that for Monzo, it's very important that they care about this, these secondary checks to gain the trust of their customer.
And Marcel and Sadra, are there any kind of other metrics that you would kind of build upon what Zeynep mentioned?
No, I think, yeah, just to Sadra's point on the being proactive, definitely plus one, definitely something that I would recommend as well, just building upon the kind of security requirements that you get obviously from your competitors, but then obviously making sure that you're meeting those standards from both just even a competitive standpoint, but also just best practice within the industry.
And Zeynep, I guess when you're looking at kind of earlier stage fintechs, what kind of security foundations would you view as kind of essential to be established as early as possible?
Mm-hmm. So for us, the licensing is very important, and that the company is thinking about acquiring their own license quite early on. As you know, we're investors in Monzo, and Monzo is a regulated bank in the UK. We're investors in Finom, which is an SME neobank that is pan-European, and they have their own license, which they have localized in a number of countries. That is Germany, France, Italy, Netherlands, and a few more. So when Finom, for example, first got started, they still do work with some banking as a service providers, but their goal was always to have their own license and serve their customers on their own license rather than banking as a service provider. So what we look for is more how the founder is thinking about it. What is their strategy, and where do they want to get to in 5 years rather than where are they today?
Can I ask why the reason for that is? Is it because of the value of the license, or having control over who they're onboarding, or is it just the multiple factors?
It's multiple factors, but I would say number one factor is having control over the full onboarding journey and the customer service journey. And of course, you will have better economics if you have your own license, naturally, because there will be less of a commission sharing agreement. That being said, when you operate on your license, you have a lot of costs associated with that, and more stricter operations. So the core reason you want to run on your license is not necessarily because it's cheaper to do that, and you have better gross profit margins, but it's really so that you can serve your customers better.
Conrad, is that something you would agree with? I'm curious.
Yeah, I mean, I think in the end, to build a really big business in financial services, it needs to be on your infrastructure and your licensing. I'm not talking about the big legacy players. I mean, I think they've lost the ability to build stuff centuries ago. But if you want to build a big new challenger, but that doesn't mean that has to be the answer on day one. And actually, I think Monzo and Revolut have both done this very well, which is sometimes when they're launching a new product or a new channel, they'll do it with a partner, and then over time they'll replace the partner when they've proven the channel. We were a bank from day one, and if you're a bank from day one, you know, there is a lot that comes with being a bank, a lot. And in the end, that has to be a high conviction bet, and it has to be a high conviction bet around two things, around scale and returns. So you're much better off not being a bank if you're not going to build a big business. And returns really matter in banking. It's fairly easy to build revenues in banking, but return on investment or return on equity is really how you build a great business. So it's not necessarily the right answer. You have to start with those things, whether it's your own infrastructure or your own licenses. But over time, if you're trying to build a big consequential business, I think that comes with the territory. So we took the decision we wanted to be a bank from day one. Our business works as a bank, yeah. And if you want to build a really scalable lending business, for example, I think you need to be a bank. It's hard to build a non-bank, very big lending business. But in the end, this is all about the chronology that you do it towards an end game. I think Zeynep's absolutely bang on, right? You want to be asking an early stage founder, what is the end game? And then some of the decisions they're taking now that might look like compromises might actually make perfect sense as a stepping stone towards that end game. You know, you're fighting on so many fronts when you're founding a startup, particularly a financial services one. Then sometimes it makes sense to kind of like take the easy route, the buy routes for some fronts, so you can focus on winning others. So, for example, what Monzo did brilliant in its early days was build virality, right? Word of mouth. It was extraordinary, right? So we were all in awe of that. So that was a battle that if you won, that was extremely valuable. So why not focus your attention and resources on that one and make compromises elsewhere? I think is a good way to build a business.
From a security perspective, are there any disadvantages to getting that kind of license so early, or advantages?
I would personally argue that if you're working with the right provider, which is a big if. So, for example, in America, there's been huge amounts of scandals around banking as a service providers. But if you're working with the right provider, and I think the bar is probably higher in Europe, which means that it's more likely to be the case, then it's actually probably the safer option. So, you know, if you're working with a provider that large blue chips also use, then the chances are that they've done a lot of homework on due diligence around compliance, around security, etc. So I suspect, actually, in the early days, it's actually the lower risk option. But over time, if you really, really want to know with absolute certainty that you're compliant and that you're secure, the way to do that is to own it yourself. You know, you have to back yourself clearly, but over time, I think that's the right answer.
How would you say that the approach kind of, I guess, evolves at different stages? Let's say when you go from Series C to Series A to B and beyond.
Well, let me give banking as an example. And obviously, banking is one of the many types of things you can be in financial services. But in the end, to justify being a bank, you have to have many billions of pounds of relatively high return assets on your balance sheet. So why do I say that? It's because up until the point that is true, then frankly, it's not good being a bank. You know, it's basically a money pit. So there is a good argument, and indeed some players have done this, famously Revolut, for building a business without a bank license and then putting that on towards the end when you already have the scale to justify it. But there's no right answer, right? The right answer is the right answer for your business model. And in our case, it was clear we want to be a bank on day one.
And Sadra, I just want to come to you because obviously, yeah, you recently closed the Series A funding round, and you kind of plan to use the funding to expand to new jurisdictions. How do you kind of plan to, I guess, build and maintain a kind of security conscious company culture as your team expands?
I think for us, it was from day dot, we had to get it right because we're in payments. You can't have, it has to be 100% correct. Have to make sure there's no breaches because it can have massive ramifications. One of the scariest ones being losing our license, which was not fun to get. It's aged me massively. So we had to get it right from day dot. And how we do that, how we did that was having high caliber developers. Everything was in-house. I've seen fintech's trying to outsource stuff, which is a bit scary. For us, it was all in-house, the best people that we could hire. We built on a strong foundation, and then as we've hired more people, they're kind of building on this foundation using the same best practices that we implemented at the early stages. Now for us, kind of scaling into the EU, into the US, Middle East, those blueprints are there. Obviously, there's some changes as we go into new markets, but the blueprints are there, and that's what we're relying on. And the best way for us is we build it in-house. We do penetration testing ourselves, and then we've got kind of outsource auditors that can come in, because you don't know what you don't know, and a developer might think this thing is kind of solid and impenetrable, but someone can come in and say, well, you've completely forgot about this root backdoor hacking. So having that additional auditing makes sure that we definitely kind of have that full solid system in place. And then you got stuff like AWS Shield, like DDoS attacks. We had one of the big payment processors on Monday. They had a massive 8-hour downtime, 2-3 DDoS attacks. So those give you additional kind of comfort and security. But it's important because as you scale and as you get better and better known, you'll have more of these attacks come towards you. So we're fielding those at the outset. That's how we've done it.
Almost. Just going to add to that, Sadra. I think like startups and smaller companies are almost like at an advantage from a security perspective. Just because you're starting from the ground, you're able to build in these practices as you have done, like into your development, into your practices from day one. So then it's a lot easier to scale. And that's what I see with a lot of teams that I work with as well. Smaller teams, but they align themselves to the bigger standards, ISO 27001, SOC 2, all those other specific PCIs, DORAs and all them. And then just scaling it up from there is a lot easier when you start from the start. You're not working with different managers, different processes. You're just kind of building them up based on these best practices. So I think that's definitely an advantage for them as well.
The only downside is when you're new, all the fraudsters think you don't know what you're doing. So you'll have multiple attacks.
Yeah.
Anyone who set up a fintech, just make sure you get it right at the beginning. Don't wait until you have an attack. That's my biggest advice, I would say.
Yeah. Proactive, not reactive, but yeah.
And we have a question from the audience that actually fits quite neatly in. So Jules Rennie is asking, in fintech, you've mentioned obviously trust is everything. If a B2C company loses the trust of some clients, can it realistically be rebuilt? And how should teams think about balancing the effort to restore that trust, or should they just focus on acquiring new clients?
No, I can have a go at that. I think there's multiple examples in business of businesses that have rebuilt trust. I think the only correct way to answer that is it depends, right? There are some situations where things have just become so existentially bad across so many customers. The brand damage is simply terminal. So I won't name names, but in the UK, we have a parcel delivery company whose name became so toxic that they rebranded. But I believe it's the same company. So I think the answer is it depends, right? And to build a great business, you need to be both acquiring new customers and nurturing your existing customers. So it's never a binary choice between the two. I think an organization that's only focused on the front book, we call it in banking, and on back book, in the end is basically building a business that will not sustain over time. We're seeing this, by the way, play out in banking. There's subject to the consumer duty. There's quite a lot of behaviors where new customers get treated a lot better than existing customers. And to some extent, because of the kind of regulatory moats that the incumbents have, these things sustain for longer than they perhaps should. But over time, customers can and do vote with their feet. So I think the answer is it depends. But there are scenarios clearly where a business can be sunk, or certainly a brand.
Zeynep, I'm curious from like an investor perspective. Do you think that's true? Can a B2C fintech that loses the trust of its clients rebuild that quite easily? And what would the steps be to do that?
I wouldn't say easily, but it can be done. I think what matters is definitely retention matters more than acquiring new customers when something like this happens. Because effectively, if you think about your, what's driving growth of a fintech, that's consumer or SME targeting, there are 3 levers. We look at retention, CAC, and ARPU. So, and retention, I'd say, is the most important metric there. So therefore, that focus on refocusing on the brand and making sure that you keep your retention and making sure that your customer acquisition costs don't go up are very important for you to continue to drive growth. And I think the way that you gain customers' trust, it is also a little bit over time, because if you think about the reason, if you lose customers' trust, that branding impact is going to be impacting both your retention and your new customer acquisition. So at that point in time, you need to kind of take a pause and give it time and do some new measures to gain the trust of your existing customers before you go back out to market to start acquiring more customers. And you need to have investors who think like you and are aligned with you, because otherwise, if they're pushing for you to grow at all expense, you might not be able to do that. And I think the way that you gain the trust of your customers is going to be through what I call the features at that point in time. So you need to focus on, I'm not calling them products because they're not really products. Those are the little things that you do to make your customers' life easier. You need to focus on those.
I think I just add, by the way, I think the actions that you take in the immediate aftermath of whatever has gone wrong are really, really consequential here. Mm-hmm. So if you're facing that situation, you really do need experts in crisis management. We did, of course, have a very public example, which is Equifax. So Equifax, the major credit reference agency, had a huge data breach on both sides of the Atlantic. And actually, largely speaking, I think they managed it quite well. They owned it. Yeah. They were honest, they owned it, they did the best things they could, even though a lot of what the damage was, you couldn't remediate it. So I think they were probably well advised, and at the same time, they were quite lucky because their industry only really has 2 or 3 major participants. So nobody really wanted to lose one of those, none of the buyers in the market. But I think that's a good example of where a company can actually sail through. They obviously took a major damage in terms of market cap, but five or so years on, right, we've all forgotten about that because I think they rode it well. They didn't have to change their name or anything like that. So that's a clear example that it can be done because they clearly need to be on top of their data security, and they weren't.
Marsel, I saw you nodding throughout that. Is anything you would add to that?
Yeah, no, it's again biased coming from an ex-auditor, right? But just the root cause analysis, as Conrad was mentioning, just making sure what happened, what's going to be done about it, and just having that transparent to customers and to like prospects as well, just showing that and ensuring the trust that you can. Obviously, it'll be a ladder and a kind of stepped process, but I'm sure, yeah, if you follow that process, you can regain that trust.
And yeah, I guess on the topic of client relationships, there's another question from Sadiq Daniel for Sadra. Yes, he's asking, do you come from a more transactional lens in dealing with the trust of clients, or do you see kind of the benefits on both parties mutually? Fintech companies tend to lose that vision as they become slightly bigger over time, which erodes the trust. That's what he's saying.
Yeah, that's a good point. And I think obviously we're kind of early stage. I'll give an example of the 2 big boys in our industry. You have Stripe and you have Adyen. Stripe is more, in my view, is more on the transactional side. Sign up, go through, you do yourself, not much kind of hand holding. And then Adyen's on the other extreme, where we'll do full hand holding, like we'll walk you through it. It's more relationship building. And for us, we're more on the Adyen side. We try to automate as much as we can on the product, on the features, and make sure the user and the platform don't have to do too much work to get everything going. But actually, when it comes to the relationship side, we have an account manager, they have a Slack account, like we were kind of there constantly. And the main reason for that is still, let's see what happens in the next 5-10 years. People are still buying from people, and they still want that relationship. No matter how much automation you're going to add in, there still needs to be that human touch, because the human is still signing stuff off at the end. So for us, it's important to build those relationships, and we make sure that we build that early on. And then as the business is growing, there's that kind of buying with them, that we're there as a trusted partner. As they're scaling, we're there to help them do that scaling. It's not just a piece of software and that's it, that's the end of it. I think back to the point that you guys were discussing before, we're not B2C, we're B2B. For us, it's super important to rebuild that trust, because first of all, retention is probably the cheapest method for us to keep a client. But it's a small industry, people talk to each other, that will get across to everyone if you're not doing a good enough job. So yeah, for us, it's super important that we build those relationships early on and then scale as we go across bigger businesses.
I would just add something, by the way, which is Amazon have an amazing phrase from one of their shareholder letters. They said, "We believe that in the long term, the interests of our customers and our shareholders are perfectly aligned." So in other words, doing the right thing for the customer over the long term in other words, it's not you versus the customer. They're aligned. And look, I mean, if you bought shares in Amazon, you haven't had many dividends, but you've certainly had one of the best share price growths in history. So they've kind of demonstrated that in real time. So I think the risk comes when you begin to take short-term decisions, right? Because you're under pressure from the public markets or your shareholders, or indeed you'd be just making compromises yourself. But in the long term, trust between you and your customers, they should be perfectly balanced. And your shareholders should be very happy about customers that trust you and you trusting your customers.
And I guess on the subject of risk taking, how do you all kind of determine which regulatory or kind of security guardrails are non-negotiable versus areas which can be a little bit more flexible to grow?
Well, on the regulatory side, right? If the regulation is clear, right, that's not optional, right? And there are some inglorious examples of players in fintech who've decided to break the rules and ask forgiveness later. That's not how it works. Yeah. And actually, when on the occasions that they seem to have got away with it, I get quite cross about that. So regulation, when it is clear cut, the answer is clear cut. You comply with the regulation. Yeah. Now, the reality is there's quite a few areas of regulation where things are grey areas. And sometimes the regulator clarifies over time, sometimes they don't. Sometimes you get mixed opinions from different professional advisors, but when it's clear cut, it is a red line. It has to be in financial services. On the security sides, or that side of things, the non-regulatory side of things, I think in the end, the art is coming down to defining the difference between rules and guidelines. So I think some of the incumbents, they make everything into binary rules, and then suddenly nothing ever gets done. And actually, arguably, you end up in a less secure and less safe place because you don't actually move forward. So we have, for example, we have a checklist that all of our product owners, they're meant to be fully versed in this, and they're meant to know when to make the judgment call that they have to ask an expert versus them making a judgment call. But of course, there are certain things that are red lines. Our release process is set in stone. Yeah, you must go through the release process, and that involves obviously testing, QA, third-party assurance, etc. So the art in these things is the difference between rules and guidelines. If everything is a rule, nothing gets followed or nothing gets done. But if everything is a guideline, you lose control very, very quickly and things go wrong. And I think that's the art to it.
And that links quite neatly onto another audience question, which I think Marcel's answering. But yeah, I guess just open up to the floor from Ruben Van Weren. Yeah, would you have to kind of adapt the speed of your growth to maintain these security standards? For example, limit the number of countries you're expanding to simultaneously, understand the legalities, or can fintech still grow at the pace of, say, a social media business?
Yeah, I was just gonna type in an answer there, but I think I better to answer it live. But it kind of depends on the industry, right? Of course, Conrad, to your point, if there's a red line, a regulation, a specific requirement, yes, unfortunately, that will be something you'll have to comply with no matter what, unless obviously there's going to be penalties if you don't. But the kind of more areas that don't have as much regulation, like the social media business that's mentioned there, obviously there's going to be a lot more nuances there and a lot less requirements. But for the red lines, once you do meet them, obviously it'll kind of be based on the industry best practice or what your competitors are doing to things we mentioned before, as like other guiding points for you to follow as well. But in terms of can you adapt to speed? Of course, like I said before, scaling it up from the beginning is a great way to do it. But yeah, unfortunately, there will be those red lines at the end of the day.
Zeynep, I see you nodding there. Is there something you would add to that point?
I was thinking of even the most simple things like pricing increases in fintech. You can't just do them by regulation. You have to communicate it to your customer typically at least 6 months in advance. So if you think about growth levers in fintech, especially when it's consumer facing, it's not as easy as unregulated industries.
Okay. Are there any kind of like investor red flags you see when I guess when fintechs prioritize growth over kind of security infrastructure?
Yes, twofold. So for example, on the infrastructure side, we look at the conversion rates. So you're targeting customers and you're spending more in marketing as you're growing, and how are your conversion rates doing? And that's usually an infrastructure problem. If your conversion rates are very low, it could also be a marketing problem, which means you're targeting the wrong people and targeting fraudsters. But typically, it's more of you not being able to handle the incoming traffic because you have a lot of manual processes. So this is something that we watch very, very closely because we don't necessarily want our CAC efficiency to go down. So this is something that we watch out for very closely. And then the second point I will have is, going back to the brand, once you lose the trust of your customers, it will first hit your new funnel before it hits your retention. Because the customers that you already have that are using you or engaging with the product, if they're happy with the product, they will probably forget about it and stay on the product unless the breach was very serious. But the new ones are not going to want to try it. So in those situations, again, I'd say if you grow too fast and you expose yourself to these situations where you could potentially lose the trust of your customer, it's not really worth it. Yeah.
Sadra, I'm curious, are there any kind of examples of trade-offs you've had to make between speed and security?
Yeah, it's a good question. So what we tend to do is, depending on how you think about him, Elon Musk has a good quote. He thinks he kind of does first principles thinking, where if there's no need for something, because especially as you go into fintech, you're dealing with legacy players. There are rules. I'm not talking about regulations, as the guys have discussed. There's red lines, we don't cross them. But there are rules set that no one knows why they're being followed. It was someone said it 10, 15 years ago, and we're just going to follow it. So we tend to push those boundaries to understand if there's a real reason. Okay, fair enough, that makes sense. But sometimes it's because the computer says no, and then we dig deeper, and then okay, there's actually no use for this. So we can remove some additional headaches from our side that allows us to grow faster while not compromising anything. Obviously, it's difficult for everyone within the organization to be able to do that. So I tend to kind of teach that to the people who have touch points outside the organization to make sure that, and they'll always check in to make sure that there's a reason for something, and if there isn't, we will push back. So that's how we grow without compromising. Again, not discussing regulations, not discussing red lines. This is just purely dealing with legacy players in the market that we have to partner with. So that's how we kind of go about it as a business ourselves.
How do you judge when it's okay to push and when it's okay to not do that?
Bit of an art, but usually I just ask why. Just why do we have to do this? Okay, well, you don't know. Okay, let's go up. Why? Until you get to the person who says, well, there isn't actually a reason because we did it like this 10 years ago, and that was because of that system there. That system is decommissioned. Okay, can we get rid of it? Yes, there's no point. Okay, we can get rid of it. So just asking why, which is a simple question, kind of can get you a lot of answers in that way.
Yeah, I'll just add a framework that I like to use, which is that I think if in your business there aren't a few fires smoldering, yeah, then you're probably not being ambitious enough. But if the fire is raging, you drop everything and fight the fire. I think that's a good framework, right? You know, you're trying to build a great big business, right? If there's no challenges, no issues, then that's probably a sign that you're not pushing harder. I think that's a good framework to think about it. But you must drop everything and fight the fire when a fire is raging. That would be my advice. I think there's one other very financial services related thing, which plays to this, which is that there's been kind of fintech after fintech that's come out and proudly announced that they've done a frictionless this or that. Yeah, friction matters in financial services. Friction is often a positive thing. So famously, we've had a number of regulatory scandals around know your customer or anti-money laundering checks. So you've had these fintechs that have been like these dinosaur banks. Everything's inefficient. We've got a frictionless onboarding. Well, guess what? If, for example, if you're onboarding medium-sized businesses in our segment and every single customer goes through without touching the sides, you're going to be in trouble. Yeah, there is friction as necessary. That's also true in lending as well. Consumer lending, for example, you should be saying no quite a lot, right? In other words, if you care about affordability, if you care about the customer, then there should be some friction to getting access to finance. And famously in the UK, we had Wonga, which didn't have much friction at all. It got shut down by the regulators in the end. So I think the nuance here is basically friction is a positive sometimes in financial services. And if everything is frictionless, you need to be asking yourself the question whether or not that's a bad thing.
Just on Conrad's point, regarding the framework, completely agree. I tend to say to the guys, you got to be failing 10, 20% of the time. Otherwise, you're not being risky enough. So yeah, completely agree with that point.
How do you kind of balance, or how do you ensure that the friction doesn't become too much, right? Like the whole point is to also onboard customers as well. Like how do you kind of balance that with, you know, obviously onboarding customers and driving revenue?
The right answer to that is exactly what Sadra said. It's about first principles. So never underestimate the extent to which an existing organization that's been around a while and built up some flab on the bones, entire tasks, entire functions, entire teams come into existence that have no practical use to anyone. In other words, they exist simply to service other teams that shouldn't exist. And look, I used to work in big banks, and I used to work in one of those big towers in Canary Wharf where there's 5,000 people in the HQ. And then I went to founding a startup on my own, just me in my bedroom at the weekends. I guarantee I could walk into that 5,000 person building and spend a month there and then explain the 2/3 of the people that you know that just don't need to be there. Yeah. It's like, what are you working on? PowerPoint? Okay, nothing. Yeah. What's your meeting about? Yeah, I don't think we need that meeting. So much stuff. When you lose first principles, so much stuff, so much non-value added activity built up over time. So it is about first principles. That's how you do it. Get right with the front and ask the tough question: why are we doing this? What's the point?
Zeynep or Marsel, I see you nodding, but if there's anything you would add to that?
I'm really already just kind of thinking about it from a process perspective, how you'd kind of go about implementing this in smaller companies and really just having a centralized mindset, right? Just all the different teams talking to each other, different risks, maintaining that trust across the teams as a first step before you're even kind of dealing with customers and businesses and vendors. But yeah.
Sorry, just to chip in and add to that, a lot of people doing non-value added tasks, they literally exist to communicate between different functions.
Yeah.
And the answer is basically put the functions together.
Yeah.
You know, if you want to get your security, your infrastructure security right, let the engineers and the DevOps and the designers and the product people, let them work together in small teams. And then they will come to a better answer, a safer answer, But the problem becomes when they're siloed and entire functions exist literally to communicate between different providers. Sorry, but I think it's a super important point.
Yeah, I've spent many weeks just considering different controls from different control owners across different teams, and yeah, that's exactly what Conrad's talking about, just teams to talk about, or meetings to talk about different teams in the process.
I think it's a continuous tension, especially in consumer fintech, where when teams are operating in silos, so when they're not centered around a new product, you'll have product teams develop new products, almost finalize it, just for it to be shut down later for the chief compliance officer. It's a very, very common pattern. And people also joke saying, it's actually the chief compliance officer who runs the company, it's not the CEO. But I think the only way that you avoid that is for your product teams to have that awareness of what will be a red flag for compliance, so it can be addressed in advance.
Are there any specific kind of tools or technologies that can be used, I guess, in regards to kind of automating the compliance process there?
I think tools is probably an overstatement, right? But there's a ways of working, I think, which is that I think one of the things that incumbents tend to get wrong is they deeply involve all the specialist functions all the time from day one. Now, there is a good argument for involving specialist functions like compliance early, but they don't need to be involved all the way through. So how I would think about this as a framework is if I'm proposing as a product person, a product owner, to build a new thing, I would actually go and have an early meeting with an intelligent compliance person and say, what are the kind of things I need to be thinking about, the considerations? And they'll be like, well, okay, there's this regulation, this is a bit random, this one doesn't really make sense, but it's true anyway. In other words, they'll give you pointers. These are the range of things that you're going to need to think about. But then I would take the leap of faith. If I was a compliance person, I'm sitting in front of a smart person, I'm going to take the leap of faith they're going to go and do their own homework. Now, they're not going to be a detailed specialist, but the point is basically, I'm actually then okay if I step back, as long as I know that it won't go live without me actually signing off the detail of what they've done. But basically that early meeting that kind of sets the direction and brings in the stuff, the kind of curveball stuff that are not obvious. A lot of compliance doesn't necessarily make sense. It is what it is. But then you take the leap of the faith that the person you've actually given that insight to is going to do something with it. They're intellectually curious. And then you can really, really get under the skin of the detail before it launches. So I think early engagement and then early light engagement and then late deep engagement is a really good model. But if every decision all the way through the steps, even stuff that doesn't actually come into production, goes through compliance, what's the point? It's a waste of resources for everybody and it slows you down.
I think on the tool side, we've had machine learning for years. So machine learning is very helpful where you're running through millions, billions of data points, but the growth of AI has been super exciting to be able to take all this data and pass it to the AI that can give a reasonable answer or analysis to then be passed on to the human side. So these data points, these kind of aggregations of data actually help reduce, again, you need some friction, but reduce some of that friction when it comes to onboarding a new merchant, where you're not just relying on what they say. You can go collect a lot of data from other sources, bring it into one place, have it run through this ML that a human can't. There's just too much for a human to run, and then bring that report to a human, say yes or no, or I need additional data, and then go back and pull that data. So we found that these tools that are, by the way, the tools are developing so rapidly, it's insane. Like there's every 2-3 months, there's something new out, doing something new. So for us, it's been, let's choose one and we'll stick with that for 12. The good thing about being a small business, like you can kind of shift quite quickly. We'll go again and we'll choose something once the market develops in 12-18 months. But yeah, these tools have been super helpful to kind of really supplement the human underwriters, the human compliance people who make the final decision within our organization anyways.
Which tools do you use specifically?
So we work with the likes of fraud.net, we work with the likes of HelioCore. ChatGPT is a godsend once you give it the right information, right prompts. So and this, I think there's 3-4 other tools that we use, the team uses, G2, Web Shield. So all these kind of mixed together, it tends to give a much better, deeper understanding of the merchant that you're about to onboard.
Are there any other tools that our panelists use as well that they could share with our audience? I'm sure they're curious to know.
I'm not going to jump in with the tool that's, I think, up here. No, just to add on to Sadra's point, and kind of something that I want to mention in terms of tools as well. Again, just from a regulation and framework perspective and a best practice perspective, just being given the guidance that the tools offer, right? Just like a door regulation comes out, a new regulation comes out, that regulation wording, if you don't have someone legal in your team, you're going to spend weeks and months of trying to figure out what, like, thou shall do something means realistically within the company. But even just being given that guidance as well, and kind of nudge points to say, hey, what this actually means for your company is you should have, change management practices in place, job processing practices in place, that kind of thing. That's also obviously a major driving point as well, a major advantage for teams. And on to Sadra's point, just around the guidance, right? Just not letting the AI and the things make the decisions for you, but informing those decisions with what it gives you is a huge advantage at the moment as well. Yeah.
What kind of, I guess, dangers could come about from relying on automated compliance systems? I don't know if Zeynep, you want to take that?
I'd say there's always human in the loop. So in a lot of these processes, from my experience, what I've seen as best in practice is, particularly for the workflows, be preferred when the companies are building this in-house rather than buying third-party tools. It depends on the workflow. So for example, for customer service, I think it makes sense to use a third-party tool. But when you think about customer onboarding, that is something, that's something that should ideally be built in-house, because you readjust it based on your appetite of risk. And you know your customer the best. Same with lending, so credit underwriting. For some very, very simple use cases, you might want to use an off-the-shelf product, but typically, for at least part of the workflow, you want to build in-house. And I think that eliminates also the risks of automation as much as possible, because then you can decide how much human in the loop you want to have in these processes.
I think the exciting question is when, and I've got no idea what the answer is, when do you remove the human from the loop? When is the machine better than the human, where the human's going to make a mistake, the machine didn't? I've no idea, but for us, it's always kind of keeping an eye out on where the market is going. But yeah, Zeynep, you're at the forefront of this, kind of invest in other businesses. So yeah, if you have any views of that, it'd be good to know.
I would say it's already better than humans in most use cases. So it's just that the decisions, especially for customer onboarding, is not black and white. There will be maybe 30 questions, and of that 30, 25 will be black and white, and therefore it'll be better for the machine to answer those than humans. The risk of the machine will be lower than the human error in those questions. But for the remainder 5, you need to have human in the loop, just because of the nature of the answer, and that will not change. Maybe
it will change
with further reasoning potentially, but it will not change, because when things are not black and white, the answer will be determined by the strategy of the company.
Yeah.
I would just add an observation. There's certain activities where the training for the machine comes as a matter of course. So lending is a good example, right? The bad loans identify themselves eventually, hopefully not too late, by not repaying you. Also in fraud, the fraudster is not going to put their hand up, but the customer who gets defrauded will tell you. Particular risk lies in those activities where nobody's going to tell you. And I'll say financial crime, terrorist financing is a particularly good example there. So in other words, if somebody finds a good way to do money laundering, they're not going to tell you, they're going to keep doing it. Yeah. One of the frameworks to think about human versus machine is how much training data there is. And actually, I have to say, even in areas like loan underwriting on complex loans, we still believe that an experienced human being will outperform, because there is, gut is the wrong word, but there is an element of they've seen it all before, and that kind of pattern recognition. And I think it's a matter of time, but it could in some cases be decades. It's a matter of time before the machine has the pattern recognition for the really complex situations. But let's be blunt, in something like a simple prime consumer loan, right? You can safely loan off an existing credit reference agency score if you choose to. So the idea that machines can't do that would be silly.
We have 4 minutes left. It's gone very quickly. So I just wanted to, I guess, round things off and kind of go around the room and pick the brains of each of our panelists and get some kind of advice, I guess, for the founders and operators who are in the audience. I'm curious, kind of, what's the one piece of advice you'd give to a fintech founder who are just beginning to scale their business on how they can kind of build and maintain customer trust while rapidly growing? So essentially, imagine I'm a fintech founder who's just beginning to scale their business in 2025, and I want to do that while maintaining customer trust. What's the top piece of advice you would give me? Sadra, do you want to start off there?
Yeah, so it's not even purely fintech based. I would focus down, this is my third business, so been through this multiple times. I would really focus down on the customer problem, really understand where the issues are, where the pain points are, and build for that. Because you start a business, you think it's going to go in one direction, but you actually, the path will show the way. You'll end up being somewhere else. I think from what I've seen, it's the founders who can really pinpoint the pain points, that can understand and kind of resolve for that, are the ones who end up being on the successful path. So that's and perseverance. Don't give up. It gets very difficult, so don't give up when it gets hard. Those are my two main bits.
Okay, amazing. And Marcel, what advice would you give?
Just going to really echo a lot of things we've already talked about just the call today, but being proactive with all the requirements, staying on top of it, being transparent with the customers, and just having a plan in place in case things do go wrong, and they will go wrong. But just having one place to kind of work on and one place to be proactive, and even security, trust, whatever it may be, would be a great start.
Zeynep, very quickly as well.
If you are thinking about becoming a regulated fintech, better to get the license first than getting the customers.
Okay. And Conrad, what do you think?
I would say that on a first principles basis, the way to build trust in financial services as a new challenger without the brand and everything is consistency is really key. Yeah, consistent tone of voice, consistent execution, do what you say you're going to do. So people come to understand what you stand for and who you are. So consistency really matters. And there's also something I haven't touched on. I'd say show, don't tell. So in our world of SME banking, all the incumbents have these glossy adverts about how much they love SMEs. It doesn't really show in their service levels, but they say they do, right? We have to show that we're different, right? We have to show in our actions. So for example, the relationship manager at an incumbent is hidden behind chatbots and call centers. Ours have their email address on the website, right? So show, don't tell, and be consistent.
Okay, amazing. Thank you so much for giving those pieces of actionable advice. I'm sure our audience will find them very useful. So just to wrap things up, thank you everybody for taking the time to attend this Sifted talk, and thank you so much to our amazing panelists as well. I really enjoyed the discussion. So if you're hungry for more Sifted talks, we'll be holding our next talk on how to scale with AI on the 30th of April, which will be moderated by my colleague Kai, alongside guests from Atomico, Clue, and Box. You can find more details on sifted.eu/talks. There should also be details in the chat box as well. But yeah, until then, it's goodbye for now. Thank you so much for joining us.
Thanks, guys.
Bye.